Welcome to the daily update, where I'll go over the action in the market for Thursday, February 29th, and then we'll see how things look for Friday, March 1st. Happy March, getting closer to spring. We've got spring training happening with baseball. It's a sport I really like to follow. Anyway, as far as the market is concerned, we had another update. There was positive reaction to the PCE report that came out, and we fell back, but then we were able to regain that later in the day and ended up being positive. What's interesting is we're seeing a little bit of strength in the small caps. They're not breaking out right now, but they are showing some improvement. We are looking positive with the S&P 500. There's always some things to be concerned about, but what we can say right now is it was a week ago that we went up to that 5111 level, hit that, and we've not been able to get above it. We got kind of close in Thursday session, but we're still below that level right now. Until we can get above that level and close above that level, we have to treat that as pretty significant overhead resistance. We are looking a little extreme to the upside, but as I keep saying, these extreme positive conditions can go on for quite a while in a positive environment. What we can say is that the overhead resistance that we hit in last Friday's session, that's hasn't necessarily been a rejection of the upward move. We came back down. We haven't been able to go above it. But for right now, we're trying to make a comeback, where the other times that we've seen this, we bounced right off of that and then headed pretty strongly in the other direction. That doesn't seem to be happening this time. Let's go back and talk about what happened. Right at the open, we had a gap higher open, which was not all that hard to do because the ranges over the last 4 days had been so minuscule that the pivot points were pretty close to each other. And I see a little typo here. That should say higher. We were above R2 at 50.88, and then prices fell back below R1 at 50.79. We came down to the unchanged level and fell a little bit below that to the daily pivot. It looked like we had a shot at possibly going negative. The daily pivot was at 50.68. But as the day went on, prices rose back above the daily pivot, back above the unchanged level to go positive again. We got back above R1 and R2, and we closed near the daily high. So we saw some late day buying going into the market. We were up 0.52% on, this is interesting, above average volume. This is one of the up days that we've seen over the last week or so where we had an increase in price and an increase in volume at the same time. We are positive with our technicals. There are, of course, some things to always be concerned about. We're still looking extreme positive in the long term. We're kind of shifting back and forth in the short and intermediate term, and I'll go through that. The market seems to like the scenario with inflation right now. Interest rates did drop just a little bit. The market seems to be in a really happy place for the time being. That can always change, of course, but for right now, everybody seems fairly content. The NASDAQ ended up finally hitting a new all-time high. Not by very much, but that was one of the other major indexes that we've been waiting to see. Now, if we could just get the mid caps and small caps to participate, that would be more across the board confirmation. The small caps are continuing to do fairly well. Not great. We're not really breaking out, but they are showing some improvement. Here's our short-term list of things looking extreme positive. We have the Williams percent R, the stochastics, and since we shot up and we've been going sideways, the standard deviations chart is looking a little extreme. In the intermediate term, we're still getting some mixed signals with our oscillators. The Sean trend meter is not really extreme, but still kind of extreme. We're back to getting a little far away from the 50-period moving average. That's the boom indicator. That measures how far away we are from that moving average. Getting a little extreme there. And then the one that's been on our list for quite a while, the 10-period new high, new low study for the S&P, that is still extreme positive. And we're still extreme with the 150 and 200-period simple moving averages. And we're still going with this same scenario. It looks like the Fed is done raising rates. They're probably going to cut rates in 2024. The big variable now is, when will that actually happen? The dollar was down and interest rates were also down. We closed at 4.25% for the 10-year yield. The yield curves that we do follow are still inverted. Sentiment didn't change, but we're still looking pretty extreme there. This is a little concern right now. We're at 79, and this is the point when we want to think, okay, maybe the market's getting a little too happy about things and could be due for some kind of a pullback or something to happen to wear off some of this extreme optimism. Our trend, this part really hasn't changed. We are positive. The green line's on top. We're going back above 40 now, so we're looking a little extreme with the green line, but we're still not really crossing above the moving averages yet. However, we're still above 20, suggesting that we are in a trending environment. The bias is positive with the up day, and our momentum continues to be positive. Even with those little choppy days that we saw with very narrow ranges, we still maintained more of a positive stance. The economic reports that came out, we did have weekly jobless claims. They came in stronger than expected at 215,000. They had expected 206,000. Last week, we had 202,000. Continuing claims were also up at 1.905 million. Last week, it was at 1.86 million. Personal income came in at being up 1%. This is more than the 0.5% they had expected. That was a little bit of a shocker there. Last time it came in up 0.3%. Personal spending came in as expected, being up 0.2%, which is down from the 0.7% that we saw last time. The PCE prices came in a little weaker than expected, being up 0.3%. They expected it to be up 0.4%, up from the 0.1% that we saw last time. This is kind of the big one. This one came in as expected, and this gave the market some reason to want to go higher, at least before we opened. And then as we were going into the close, the core rate came in up 0.4% as expected, up from the 0.1% that we saw last time. The Chicago PMI, it was weaker than expected, coming in at 44. They expected 47.6. Last time it was at 46. And pending home sales were down 4.9%. With the rise in interest rates, we're seeing kind of across the board weakness in real estate right now on all the different reports that we follow. They expected it to be up 1%. Last time it was up 5.7%. Here's a few charts. These are the weekly jobless claims where they're starting to go up, but we're still seeing our moving average going down. So there's a little bit of a contradiction there. We are going up with the continuing claims, and the moving average is continuing to go up that way as well. Here's everything together. It'll be a week from Friday when we get the next employment situation report with the updated version of the unemployment rate. Here is personal income and spending year over year, where we're seeing spending going up, and we're also seeing income kind of flattening out, but they're still looking healthy for right now, given the environment that we're in. This is the big one, core inflation year over year. It continues to decline, and that's what the market likes. Then month over month, personal spending was up. There must have been some good sales going on there. Here's the Chicago PMI, which is showing a weakening trend right here, and we're below 50, so it's showing contraction in the Chicago area. Here's some blog charts to show you. This is the NFIB Small Business Confidence Index. This is something that I talked about earlier in the week, where we're comparing it with the index itself with the moving average. And it's just showing that small businesses are not really optimistic right now. Is that going to feed into the economy being more negative, or are we getting to levels where we might start to see a bounce here? We're below this red dashed line, and usually when we drop below this, that's typically when we go into a recession. And there's still evidence that suggests that we might go into a recession, but there's also evidence to suggest that we won't. And that's the debate that's gone on for a couple of years now, and will probably continue to go on until we start to see more uniformity in the reports that we're following. And then this is looking at the 4-year presidential cycle, the average returns. This is looking at March, where we tend to start off pretty good in March historically. Then we have a weak period, and then it bounces around for a while. And then sometimes we have a little bit of weakness going into the latter part of March because it'll also be the end of the quarter. But typically we do see an upward move when it comes to percentages, and we're up about 66.7% of the time during a presidential election. And then this is looking at the probability of a recession. Now, these red lines are forecasts, but it's still kind of high. It's above 60% with the latest actual reading that we've had. They do expect this to go up and then end up coming down as we move forward here. Here's our intraday chart where this looks like a big move because the last 4 days have been so muted. We gapped up above R2 and kind of established a high right here. And then we came back down, we filled the gap, and we actually went negative here for just a little while. We came down a little bit below the daily pivot, and it looked like right in here, it's like, okay, things could really be getting ready to fall apart. But nope, some buying came back in. We went back positive. We got back above R1. We even ended up getting above R2. We tried to make a little spike up right at the end, but then we closed pretty much at the high for the day. You notice that the high was 51.04, roughly 51.05. We tried to get kind of close to this 51.11 level here, but we're still a few points away from that. Here's the intraday chart. Things were relatively, well, a little bit negative. We were somewhat positive in the initial overnight session. And then when Europe opened, things went more negative. But then after the PCE report came out, that's when we really saw some strength in the market. Here's the choppiness that occurred, and we're slightly positive in the initial overnight session. This is still a little bit of a concern. We're seeing the red line above the blue line. That means that value is still outperforming growth on an intraday basis for the S&P. But we did see a little bit of an improvement here with our growth to value ratio intraday, where growth did show it's not breaking out. It was holding up as we were going sideways, but it is at least not falling apart yet. Here's our end of day charts where growth was up more than value in the large caps, the mid caps, and it was down less in the, it was up less in the small caps when you compare growth to value. So we came down just a little bit with the growth to value ratio for the small caps, but overall we have been showing some improvement. We're not really seeing much of a breakout here with this index. It's the Russell 2000 ETF that's looking a little more positive right now, and I'll show you that later. We also are coming back to previous highs here with mid-cap growth to value. So this is holding up, and we're looking a little more healthy here with this particular index. Here's S&P growth to value. We're coming back to the previous level here, so we're not breaking out, but we continue to hold up. We have seen a golden cross with this ratio. Looking at discretionary versus staples, also showing some improvement here, but not really breaking out with any convicting strength, at least yet. We're not really seeing much of a change with our ADX. We're still right on top of the moving average. The green line is on top, it's turned back up. We default to positive, but be aware that we are above 40 with the green line. Also above 40 with our short-term chart, right on top, kind of trying to turn back up here in the short term, but nothing real definitive, at least yet. Volume did pick up. This was an above average day that we saw on Thursday. Here is sentiment, not a real big change with the Ulcer Index. With the slight update, we came down a little bit with the line chart when looking at the VIX, and we're still right about in the midpoint here between the moving averages based on the bar chart. We did see volatility of the VIX drop off a bit with the update, and we're falling further below the moving averages. The MACD is starting to trend down, at least on a momentum basis, where it had been climbing since the first part of December. This could be more positive for stocks. Here's the one-day equity put call ratio, which actually shot up. This could be some hedging ahead of Friday and possibly ahead of the weekend. But when we look at the 5-period, we're still going down for right now. So that would be positive for the market. We want to keep an eye on the skew index. We're starting to get close to this red area here. We're not there yet, but if we go up into this red area, that means the market is anticipating some kind of a big move. We could drop down very easily, but we could also go back up into this area at the same time. We did get the latest reading from the American Association of Individual Investors. This is from a week ago, and they're looking more positive, but not necessarily extreme positive. We follow the red line, which also is looking more positive. And this was out a couple of days ago. This is Investors Intelligence showing that we are extreme positive with sentiment there. The advanced decline line, we are breaking out based on price, showing a little bit of an improvement and a slight breakout here based on volume. With the new highs versus new lows, we are still expanding. We're going up with the 5 period and the 10 period. So this internal measure still looks pretty good. With the advanced decline ratio, we're still above zero and advancing. So that's positive. The accumulation distribution, a smart money indicator, is still showing some improvement here. And we really clicked back up with the Chaikin money flow. You might make a case that we're getting extreme, but we have had higher readings than this. What's more positive here is that the red line has now turned and started to go back up, and we're seeing a bit of a turn back up with the Chaikin oscillator. I wanted to show this. I haven't showed it in a few days. This is the cumulative advanced decline line for the NYSE with the up day, and this calculates things a little bit differently. So we're seeing a bit of a spike up here. When we look at our regular NYSE advanced decline line, we're actually starting to break out. So this is showing more broad market improvement. Here's another look, but this has a bit of a concern. This is the NYSE common stock based on price, where we're coming back to previous highs, but we're seeing a bit of a negative divergence here based on volume. We haven't broken out there. So that is a little bit of a concern. Looking at our advanced decline line studies, we did show an improvement with the NYSE common stock, but we're not past this previous high that we set back in December. We are breaking out with the S&P. We're showing some improvement with the mid caps and starting to break out. We're turning up with the small caps, but we have some previous highs that have to be dealt with first. Here's our intraday or our daily chart where we're still above this trend line. For right now, on the bottom, this is where volume was finally above average for the first time in a number of days. We are looking extreme positive with the Williams percent R. The CCI 20 is just barely looking extreme positive. We're turning back up with the 20, 50, and 200 period moving average studies. And we're above the midpoint and starting to advance with the force index. We're looking extreme in the short term with our stochastics, intermediate, and long term. And this is a further subdivision of the short term. So I have short term, intermediate short term, and long short term. We did get slightly into the +3 channel with our standard deviations chart. So because we were chopping in such narrow ranges, it really picked up that upward move. Intermediate term, we're kind of declining, but we're trying to turn back up here with the balance of power, but it's still positive since we're above zero. We're still positive with the go, no-go system, and we continue to be positive with the highest high value. The TTM squeeze is trying to turn back a little more positive, but we're still seeing the dark blue bars. And we're turning back up ever so slightly with the ease of movement, and we're above zero. We did really drop off with the Arun after giving us an extreme positive reading. And so this is a whole different kind of calculator. So that's why, or indicator that is calculated in a different way. And that's why we see some pretty weird readings sometimes. We are above zero and advancing with the S&P McClellan oscillator. So we're turning back up with the summation index based on price and volume. We're still wondering about this longer term negative divergence. But if we can turn and go back up, it may be able to negate that. We're also above zero with the NYSE McClellan oscillator. And we're continuing to go up with the summation index based on price and volume. Still seeing a longer term negative divergence here when compared to the S&P 500. We actually declined a little bit based on price with the Swenlin trading oscillator. We were pretty much flat when we look at volume, but we're still above zero. And our oscillators, they're pretty much chopping sideways. We are looking more positive based on price. We're just barely starting to turn up based on volume. So we saw a little bit of an improvement with the PMOs that are rising. The buy signals are going up, and we're starting to go back up with the PMOs above zero. We've switched from being neutral over to positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. The slope is continuing to go down and actually starting to drop below its moving average. And the MACD is still pretty much right on top of its moving average. So we're seeing kind of some negativity here, but we're getting extreme positive readings, but nothing really definite right now as far as momentum. We're still above all of the plotted moving averages here in our moving average tree. And this is more positive. For 2 days now, we've seen the bullish percent index start to go back up. So that is showing some internal strength. What this measures is point and figure buy signals or sell signals inside of the S&P. This is not moving average based. And so this is more of a real-time look at the internal nature of the S&P 500, and that is showing some improvement. We're also going back up with the NYSE bullish percent index, but we declined with the NASDAQ 100 bullish percent index. The money flow came just about down to 50 and is now starting to bounce back up. Ultimate oscillator continues to go up and is above 50. The vortex is declining, but the green line is still on top. We're still seeing most of our latest readings with the RSI based on 14 and 9 periods above 50. So that continues to be positive. On balance volume continues to be positive. We're still seeing this negative divergence with the 20-period moving averages. These are the stocks inside of the S&P 500, but they are showing some improvement. Also seeing a little bit of an improvement with our 200-period moving average study and our 50-period moving average study, but we're still concerned about this longer-term negative divergence. The Copic curve continues to be negative. The Sean trend meter is not extreme right now, but still kind of extreme. We are still holding up okay when we look at the S&P 500, and now finally the NASDAQ, just barely, but it did set a new all-time high. Here's another new look at Dow theory where we look at the equal weight index that continues to hold up and has recently set all-time highs, and we have the Qs, which are just recently setting all-time highs. So we're seeing some more confirmation, at least in these areas. Our different charts, the Heiken Ashi is turning back a little more positive. The Kegi has turned back up. That's positive. The Renko is positive, and the 3-line break is positive. We're still above this trend line. We actually broke down a little bit below it here for when we were going down, but we were able to close up above this trend line. So this is suggesting that the shorter term, even though I put it in the long-term section, the shorter term uptrend for right now continues to be quite positive, and the 20-period moving averages are still underneath this trend line. And we're keeping an eye on this. We're getting close to this R1 level, which is at 51.11. We really want to watch that because we came up here last Friday, hit that level, and then came back down. Well, instead of turning and reversing like we saw in 2021 and even in 2023, we're not seeing it really dealt with yet. It's not rejecting that. So is there a chance that we could break through this and actually close above that? But until that happens, it's going to be much more difficult to have a positive slant on things. Long term, we're still extreme with the 150 and 200 period moving averages. We're still looking solid with upward pointing arrows when we look at the S&P, mid caps, small caps, and the NASDAQ 100. All of the signals or alerts that were generated in Thursday's session were positive. We had the S&P going above 5,100. We're still looking good here when we look at the total stock ETF. That's just coming off of recent all-time highs. The equal weight is still holding up better, even though the mega caps outperformed. So we saw our ratio going back up slightly in Thursday's session. The Dow had an update. It's not really breaking out, but it's still above these pivot points. And the diamonds continue to be neutral. And we're chopping sideways too with the NASDAQ, but we were able to eke out enough to generate a new all-time high. The NASDAQ 100 also closing near the high end of its bar, but not really breaking out, at least yet. We've switched over to positive after being neutral with the QQQs when looking at the Elders Impulse system. However, the NASDAQ 100 momentum continues to be negative. And we're watching this longer term. We have the previous high in this ratio that was set in 2000. That was before the dot-com bust. We had the other high that came up to the same level in 2021. We're back up at that level now. Is this going to present some kind of a problem and then start to go down, or are we going to break through and be able to set a higher high here? There's a lot of perma bears that are just salivating right now for sure that everything's going to fall apart. And they may be right, but we also want to look at this in the context of what are our other charts telling us. The small caps, when you look at the S&P small cap index, it's still above its 50-day moving average, but an awful lot of choppiness. We have switched back over to positive with the Elders Impulse system for the small caps. This is looking a little more positive when we look at the Russell 2000 small cap ETF. We haven't broken out above this previous high set back in December. That would make things more positive. We did close well off of the high. We're above this support level. We're above the 50-period moving average. We have a longer-term uptrend. The RSI is above 50, and the momentum is positive for right now. But we want to see a close above this December high to turn more positive. The mid caps are kind of breaking out a little bit and showing more improvement, and they're turning back over to positive with the Elder's Impulse system. Didn't set a new high with the FANG index, but we're still near all-time highs. The financial sector is still in a pretty solid uptrend, even though it was down slightly on Thursday. We're keeping an eye on New York Community Bank, but it's kind of settled into this sideways action currently. The dollar is still above both of its moving averages. It was actually down a little bit, but earlier gains that we saw in the week are showing this going back up. We did decline with the 10-year yield, so that means we were up with the 10-year based on price. And then looking at growth of value, coming back up to the moving average when we look at the Qs compared to the S&P, but the moving average is starting to turn down a little bit here. We're seeing a little more improvement when we compare discretionary to the S&P, and we're climbing above the moving average. Large cap growth is coming back down to the moving average when compared to large cap value. So we're still above, slightly above the moving average with the large caps, mid caps, and small caps. We're still positive with our broad market range of the 5-period moving average of the highs minus the lows. We're still extreme positive with the 10-period average of the S&P 500 highs minus the lows. So what's our outlook? We are positive and we're holding up for right now. We do have some extreme positive readings. If we go up, it's going to be that overhead resistance. And are we going to be able to close above that? That's kind of the big thing. But we're also we're kind of shifting back and forth as far as seasonality. We do see some positive pop seasonally in the early part of March, but then we see some weakness after that. We're going to get the S&P Global U.S. Manufacturing PMI. That'll be coming out. The big one is going to be ISM Manufacturing as well as consumer sentiment. We're also going to get construction spending, and then we want to watch everything that's going on in the world. Here's the finished calendar now for the week. Seasonally, for March 1st, we are positive across the board with the Dow, S&P, and NASDAQ. To go through this a little bit, we're still working off of this idea. Since January was up, the market tends to follow that 72.6% of the time when we're having an election year, which is what we're having. And we were up 1.6%. And when that happens, by the time we get to the end of the year, we average at about 20% for the year. March typically sees mid-month strength and late-month weakness. That's because we're coming into the end of the first quarter. Over the last 74 years, we're up 65% of the time, down 35% of the time. And then I'll deal with the options expiration stuff as we get closer. So this is what we're looking at historically, where we might see a little bit of a bump up here as we start to enter into the month of March. When January and February are positive, March tends to follow suit according to the Carson chart. And we're possibly starting to get beyond this little dip that we're seeing with the Stock Traders Almanac chart. But then when we have the sitting president running for re-election, after seeing a pop at the first part of March, we tend to see some weakness after that. And I don't have the daily charts yet for the Stock Traders Almanac. I haven't received those, and I haven't received Tom Bowley's latest research. We're now slipping over into March where things tend to look better, not necessarily during an election year. That's the black area. But over the past number of years, it tends to be more positive, but it can be pretty bumpy along the way. Friday is the second most positive day of the week. And then looking at March altogether, we're up 11 out of 18 times, down 7 out of 18 times. The return going back to 1950 is up 0.4% during an election year. And then taking all the years together, we're up 64.9% of the time with an average return of 1.1%. So the warning signs, volume has been decreasing typically when we're having up days, but it actually increased on Thursday. So that was rather encouraging. We are seeing a whole list of negative divergences here with the McClellan or the oscillators, the McClellan oscillators, the summation indexes, the small and mid cap indexes, discretionary, the transports. We're still seeing all of that. And that, even though it might be improving a little bit, it's still there. The Copic curve is still negative. We're still dropping and below 70 with the NASDAQ 100 bullish percent index, and the momentum for the NASDAQ 100 is still negative. And we're still in this potentially maybe day or two of positive seasonality, but we could then slip over into what is typically negative seasonality. Positive signs, we are seeing growth holding up, not just in the S&P, but the small caps, the mid caps, and so forth. The equity put call ratio for right now is going down. The parabolic SAR is positive, and we're looking really positive. Even though we're not getting much from our oscillators right now, they're still giving us very high readings. The vortex is positive. Small and mid cap growth is positive. The financial sector is positive. So our conclusion, in my book, we're positive right now, but it's that overhead resistance that's a pretty big deal. Are we going to deal with it in Friday's session? If we do deal with it, can we close above that? And then weak seasonality, we kind of go through a positive time before we slip into more of a negative time. And that's what we're watching in the short term. Intermediate term, it's pretty much about that overhead resistance. Long term, we're still positive, but we are extreme when we look at the 150 and 200 period moving averages. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.